Hello and welcome, friends. It is 8 p.m. Eastern on Wednesday evening, which can only means I was watching an episode of Squid Game and had to cut it short to come here to fire this thing up. True story. Um, but no, it is Taxes and Retirement live. Thank you for joining. I am Andy Panko, host of this wonderful production here. I was listening to Scarlet Begonias as I got here, so I had to cut my Squid Game episode short, ran over, realized I did not change my sign earlier today. I had to do it now. Tonight's topic is rentals. We'll be talking about taxation of rentals, and had a few minutes left and decided to play some Scarlet Begonias as my Fire Me Up for Tonight song. I don't know what it's about. I like to think it's about a girl. I've also read or heard about heroin, which I do not condone in any way. Nonetheless, it's a lovely song, and for some odd reason, it gets me going, like amps me up. I don't know why. I didn't think that was their intention when they wrote it. So anyway, tonight's topic is all about taxation of having a rental property, owning it, operating it, eventually selling it, which I know lots of you have questions on. Now, full disclaimer, in addition to my normal disclaimer I'll put on soon, I am not an expert in all things rentals. Of all the topics we've done so far, rentals is probably one I'm least confident in. And I know there's things tonight that are only scratching the surface. I think all these things are right to the best of my knowledge and abilities, but definitely do not quote me on anything here. Work with someone, an accountant, a financial person who has specialization, expertise in rental properties. If you have questions or need plannings around rentals, especially complicated stuff, multiple rentals, or it's one thing if you own it, you never live in it, you just rent it out and sell it. That's straightforward enough. When you live in it at some point and rent it out at some point, that's when things start to get complicated. You may have to prorate deductions and expenses, and then when you go to sell it, it's hairier. So anyway, before we do it, formal disclaimer: this video is only general explanations and education. It is not specific tax, legal, or investment advice or real estate advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which I am not. Especially again tonight, I am not an expert in all angles of real estate and in owning and renting and the tax implications of real estate. I know enough to be dangerous. I owned a couple rentals myself, but I bought them, only rented them out, then sold them. That was relatively straightforward. Like I said, it's when you own it, when you live in it, things get a little pricklier. So comments are working. Hiya. Great. Thank you, Mr. Fultz. Dad jokes for tonight before we get into it. What is the difference between a clown and an athletic rabbit? One is a bit funny, and the other is a fit bunny, of course. Come on, people. How did you not know that? This next one. Weight loss. So I am at, as of Monday, on my weekly weigh-in, 169.7, which is down 6.4 pounds from where I started 4 weeks ago, which is good. Again, pound to a pound and a half was my target per week, which I am tracking. I know last week, as I mentioned, was a bad week because of the wedding a couple days before. I was fat and bloated, but now more or less back on track. So anyway, and the second dad joke reminded me of that. I burned 2,000 calories today. I left my food in the oven for too long, scorched it. And finally, 3 conspiracy theorists walk into a bar. You can't tell me that's just a coincidence. Get it? That's the joke. Conspiracy. Okay. Where's my friend? He thought that joke was funny. Where'd he go? Thank you, kind child, for that applause. So rental properties. Let me get my slides. I will happily do questions. I'll try to save them toward the end. Feel free to post them up now, but I'll get to them at the end. Again, I'm not 100% confident in my real estate taxation knowledge, especially some of the more complicated scenarios. But so take this at sort of face value. I do believe this to be accurate and correct, but again, big fat disclaimer that I do not provide any guarantees or warrants that it's all completely accurate. Where's my screen share? Here we go. Share. Sunny and share. Okay. So let's start by first understanding that for most people, when you own a rental property, it's not an active business. You're not actively engaged. Even if you are engaged in that, you're the one finding tenants, cleaning the place, doing your own repairs, whatever. it's still different. It's not really a business in that sense for most people. And I'll explain what I mean by that. So generally, it's a quote unquote passive investment activity for most folks. So even if you materially participate, and I'll define what that means in the next slide, and most of you who own rentals probably do materially participate in that. You do the finding of tenants. You go there to drop off keys, to do some repairs, maybe. Um, Whatever, they hear a weird noise, they call you in the middle of the night, you go over, see what it is. So you may be actively involved and materially participate, but it's still a passive activity for you. On the other hand, if you're a real estate professional, your activities, your interest in your rental properties are not passive at that point, and there's tax implications to that. So how do you, or what makes you a real estate professional? Well, if more than half of the personal services you performed in all trades or businesses during the tax year were performed in real property, trade, or businesses in which you materially participated, and it's both conditions, you perform more than 750 hours of such services during the tax year in real property, trade, or businesses in which you materially participated. So do the math. I don't know how many hours. There's 52 weeks in a year, so 750 hours or 52. So that's at least 14.4 hours per week for 52 weeks that you're materially involved, materially participating in real estate, trades, services, or businesses. Now, for the people, if you just own, a rental property or two or three as kind of a side thing, you're probably not going to meet that. The other wrinkle is if you work for a big employer like a real estate business, just because the majority of your day job is doing real estate stuff, that doesn't mean your own rental properties are automatically considered non-passive simply because you're a real estate professional there. It has to be the hours and the activities you do in your own rental properties need to meet these two conditions for you to be a real estate professional. If you are, this is where I don't even know exactly what the tax implications or benefits are. It may be deemed like a form of self-employment. I think how it gets reported then gets differently on your tax return. And I think you can also deduct losses year to year, whereas with passive rentals, you can't always deduct, and I'll touch on that. So anyway, I didn't dig too much into this because I think majority of you won't hit real estate professional classification. If you do, that's outside the scope of tonight's video. Sorry, but majority of you are not going to hit that hurdle. All right, where am I? What is material participation? So remember I said, if you own a rental, even if you materially participate, it's still generally going to be a passive investment activity for you. So don't worry too much about this, but this is what would qualify as material participation. Basically, if you're participating more than 500 hours during the year, working in or on the rental business, if your participation was substantially all of the participation of all individuals, and it's any one of these things qualify, or if you're participating more than 100 hours and you participated at least more than anyone else. So any one of these conditions, it's not too difficult to hit this material participation hurdle. But again, that doesn't mean you own a rental condo, that it's a active business for you. It's still just a passive investment activity, which means there's limitations around how much net loss you can deduct year to year. So this is material participation. Renting out your residence. So what exactly is a residence versus just a vacation property or a second home or a rental? In IRS speak, any property you own is considered one of your residences if you use it for personal use more than the greater of 14 days or 10% of the total days you rent it to others for fair market value, fair rental price. So what does this mean? If you, for example, live in the house more than 14 days, so 15 days or more, chances are, this is a residence. It's going to be deemed a residence by the IRS. Or the second condition here, 10% of the total days you rent it out. Let's say you rent it for 80 days and you used it 8 days, then that's what that means, 10% of that. But you have to look at the greater of again. So let's say, I'm just trying to do an example. Let's say you rent it out for 300 days and you used it. So 10% of that would be 30. So if you use it for 30 days and you rented it for 300, well, then you meet this test where this is deemed a residence because it was 10% of the total days you rented it out. Make sense so far? Again, not an issue if you buy a place purely for investment purposes and never live in it. You just rent it out. You don't have to worry about any of this nonsense. But if you do, like you have a vacation home, second home, for example, that you decide to rent out, well, guess what? Maybe you need to consider part of it your residence, which gets complicated because you have to start prorating deductions and expenses and things like that. Now, if it is your residence, again, whether it's your main home or a vacation home or something, if you rent it for fewer than 15 days, so 14 days or less out of the year, guess what? You don't have to report any of the income, but similarly, you don't get to deduct any of the expenses. It's kind of as if it never happened. It's just like, you let a friend live there, rent there for 10 days. He or she throws you, a couple $1,000. You can just pocket that. You don't need to report it, but you also can't try to deduct, the cleaning expense to wash the sheets or the whatever, 10 days worth of electricity that your friend used. You can't do that. So just as far as your taxes and tax return go, if it's your residence and you rent it 14 days or less, you don't need to report anything. If you rent it for 15 days or more, and again, it's your residence, so meaning you live there, you use personal use out of it for one of those conditions up at the top of the screen here, then this is where it gets clunky because you do need to start prorating your expenses. So, if your total electric bill for the year was $2,000 and you rented it for half the year, well, then you can only claim an expense deduction for $1,000 of that electricity bill, because half the year was your own personal use. You can't deduct that. The other half was, attributed towards your rental or business use. So you would be able to deduct that. And I'll show an example of deductions in two shakes. Where to report rental activity in your tax return. I do have a sample here to show you, but generally, again, I'm looking at you all that are not real estate professionals. So this is just a normal, you own a rental or few as a passive investment activity. It's going to go on your Schedule E. There are some exceptions. I've never seen this. This is, again, where I'm not an expert in this, but from what I understand, if you provide substantial services to the tenants in conjunction with having that rental, then you report, I don't know if it's some or all of it, on Schedule C. So Schedule C in the tax return is normally for self-employed people. You have a business, that's where you report it. Schedule E is passive income, like rentals or royalties or something like that. So if you do provide substantial services to the tenants, then you report some or even all of this activity on Schedule C. What are substantial services? Basically, you're acting like a housekeeper or a maid for that person. So it's one thing if you just do like occasional fix-ups and repairs and, washer breaks, so you go fix it. That's not considered substantial services. But if you are doing things, think about like being in a hotel. Someone comes in to frequently clean it for you, to change the sheets for you, and other sort of maid-like or sort of like concierge services, I guess. Those are substantial services. In that case, you're actually sort of providing a service above and beyond just renting them the place. You're providing a service to them. So that, in effect, is sort of, my guess is that's kind of deemed like some sort of self-employment as opposed to a passive investment activity. Hence, you would report that on Schedule C. But I don't really know the full background of that or why it is what it is. So again, don't quote me on the substantial service thing. I haven't seen it in practice. Most of the rentals I've seen people have, or myself included, are just on Schedule E. All right. What expenses are deductible? This will be the fun part. Let me show you a different thing here. So I made a mock little tax return. Sure. Okay. All right. So married couple. Again, this is the same fictitious couple I think I showed you all before. It's just sort of the dummy names that my tax return preparation software gives one of these pre-canned fake returns. And these are fake Social Security numbers. So I want to keep this pretty straightforward. The couple has $90,000 of wages. This shows up like any other wages due on your tax return. And then here, this is the one to pay attention to. This is the net rental income, $12,727. The rest of this is pretty straightforward. It's just add those two up minus your standard deduction, and then you have your tax owed. So I don't want to make this too complicated. But where does this come from? This doesn't just magically show up on your tax return. You have to figure out what your net rental income is. And that gets pulled in. It's a bit of a roundabout. That gets pulled in from Schedule 1. Schedule 1 has a bunch of other sort of off to the side things that all get summarized here on Schedule 1. And then all these amounts on Schedule 1 get summed and plopped into your 1040. in this case, since this tax return is so simple, the only thing on Schedule 1 is this net rental income here of $12,727. Where is it actually broken down? Boom, here we go, Schedule E. So Schedule E, again, is where most people who have passive rental properties, passive rental income, are going to report things on Schedule E. Don't get too hung up on it, but basically it shows that here's the address of the place. Here's how many days it was rented versus personal use. This is where it starts to prorate things. This is if you have a qualified joint venture, which is something spouses can do where they can equally own in the business 50-50. And then you got to list the type of property it is. But okay, moving on. We'll just assume this is a house. It's a house in Cincinnati, which is where this fictitious couple lives, 123 Main Street, Cincinnati. So now, fairly straightforward. Start at the top. Here's your gross income. So I'm assuming rent was $2,000 a month. The place was rented the whole year, which means $24,000 of gross rents received. Now here's all your different expenses. Fairly straightforward. Advertising. I mean, I guess this isn't accurate because I'm assuming these people were here all 12 months, yet I'm showing like advertising expenses, but just play along, humor me. So 24 grand in gross rent. You had $100 in advertising. Let's say you threw an ad up in the local paper to try to find tenants. Auto and travel expenses. So you can deduct mileage deduction. So if you have to drive to and from to show the place, to drop off keys, their washing machine broke, so you drive over there to take a look. Keep track of all that mileage. Keep good records because the mileage is deductible at the business mileage deduction. I forget what it is this year. It's like, I don't know, 57 cents, give or take a couple cents. It changes a little bit every year. So for every mile you drive during the year directly attributable to your rental and having that rental, you can get a 57, again, give or take a few cents deduction. So I'm assuming however many miles this was, I forget what I plugged in. It's a little over 100 miles, I think. They can deduct $69 of basically wear and tear and gas is kind of what that mileage deduction is intended to cover. Cleaning and maintenance. So I'm assuming you flipped over tenants during the year, so you had to go in, clean some stuff a little bit. Insurance, as the landlord, you have to still have some sort of property insurance on it. The renter has their own to cover their own stuff, but you as the landlord have to have the insurance to cover the structure itself. So I'm assuming $200 a year. I'm just making that up. I'm assuming you have a mortgage that you used to buy this place, and total interest paid on that mortgage was $1,000 during the year. Repairs. The sink handle was loose. You had to go buy a new handle and pay a plumber to put it in. So it was $150. Taxes. This is like property taxes, $4,000 a year. This is Ohio. So I'm assuming 4,000. Here in New Jersey, single family house would be 10 grand, if not more. But anyway, so I'm assuming $4,000 of property taxes. Depreciation. This is where I think most people understand all these expenses so far. Depreciation is a new concept to folks if you haven't dealt with rentals before or otherwise have a business with depreciable property. Depreciation in a nutshell is just simply things have a value and that value depletes. Like the useful life of that is X amount of years, and it's assumed the value of that thing depletes or depreciates over time. With rental properties, and there's a separate schedule I'll show you here, but rental properties are assumed to depreciate. Their useful life, if you will, is 27.5 years for residential real estate. So that means whatever price you pay for the place, you depreciate that value equally over 27.5 years. You don't depreciate land. So I'll show you the assumption I use, but the non-land part you can depreciate. So the building itself can be depreciated equally over or linearly over 27.5 years. Each year's worth of depreciation you can claim as an expense in that year. Sounds great, right? And it is so far. So all these things we talked about so far, these are actual cash expenses. Like you had to actually fork over $100 to pay for this ad. You had to actually fork over $4,000 to get this, to pay property taxes. This depreciation expense, you're not actually paying this $5,454. It's not an actual outflow from your checkbook, but you're still getting the benefit of deducting it as an expense, which means it reduces your taxable net income all said and done. So seems awesome, right? And so far it is. So anyway, you sum up all these expenses from advertising all the way down to depreciation, and it was $11,273 of expenses. You net that off against your 24 grand of gross rental income. And here's now your net rental income. This was the 12,727 that you saw pull into this Schedule 1, which in turn pulls into the 1040 right here as other income. Makes sense so far? Now, let me just show you a little bit more about depreciation. So tax return software does this all easily. I mean, if you're doing tax returns by hand, I mean, I don't recommend doing it by hand, especially if you have rentals. You can, but it just makes it a lot more complicated than it needs to be. And just showing, oh, there's a form here that calculates or sums up the depreciation. This will be included. And here's where the car thing is, for example. Do I have it here? Yeah. So I'm assuming I used my 1978 AMC Gremlin, and I had 120 miles of related mileage to and from my rental, or even to drive to Home Depot to pick up fix-it parts. That mileage is included because that's mileage that I have as a result of trying to serve and own my rental. So the 120 miles I used on my 1978 AMC Gremlin, that's where I got that $69 mileage deduction for. So you can do the math, figure out however many cents per mile that is. All right, so here's the depreciation schedule. Let me see if I'm slick enough to be able to figure out how to rotate this. View, rotate clockwise. So this is all generated by the tax return software, and this is important to have and to pay attention to if you have rental properties. So this breaks down all the depreciable assets. Here's what I bought. I bought this house for $250,000 total when I bought it new. 150 of it was attributable to the building itself, the house, the structure. 50,000 of it was attributable to the land. So in total, that's 200 grand. Now I'm not assuming any costs I had to buy it or whatever. Let's assume that was all transaction free. So my basis was 200 grand. My original cost, again, 150 of that was the structure, the building. 50 of that was the land. So the land does not depreciate. It's simply, it's an accounting fact. Don't ask why. It just is. Land is assumed to never lose its useful life. It's land. It's a pile of dirt. Now there are some exceptions, I think, where if it was used for some toxic dump by some manufacturing plant, then sure, I think there's I'm not a tax expert on that, but I think there is a way you can sort of write down the value of the land to account for the fact that it's now like depleted wasteland that nobody can use type thing. But otherwise, you buy a house, the land never goes down in useful value in the eyes of either IRS and accounting folk. So anyway, so the only thing you can depreciate is the $150,000 building is what can be depreciated. The land itself cannot. The life, and this is right out of tax code, so 27 and a half years. This is the depreciable life. This just means straight line method. So all said and done, it means this 150 grand you depreciate equally, linearly over 27 and a half years. I bought this place in 2015, I'm assuming. So this year's depreciation is 3.636%, which is on this 150 grand, $5,445 of depreciation. In prior years, the prior few years I've owned this, I'm assuming the depreciation was cumulatively $27,045. Add to that the $5,454 of depreciation I'm taking this year, and my new accumulated depreciation is now $32,499. Why does this matter and why is this important? Like I said, well, when you go to sell it, you have to quote unquote recapture depreciation. I will explain what I mean by that, but this is important. You will be taxed, even though you get a deduction in the year you depreciate this expense of $5,000. Like I said, feels good now, but it comes back to bite you. All this accumulated depreciation you expensed or could have expensed while you own the place, you need to pay ordinary income tax on up to a cap of 25%. I'll go over that in more detail. You have to pay ordinary income tax on all the depreciation you expense throughout the years when you eventually sell the place. So that's why I said depreciation expense feels good year to year when you're getting that deduction for a non-cash expense you didn't actually have to pay for out of pocket. It comes back to bite you when you sell the place. So that's the tax return. Hopefully you found that somewhat helpful just to show, and anyone who has rentals, definitely pay attention to your return and just see what goes into it, if nothing else, just so you know what's going on. All right, so let me bring back my slides. Stop that. Come back here. What if you have a loss? on your rental year to year. So in the example I showed, there was, what was it, $12,000 and change net income for the year from the rental. What if you have a loss? So for example, I don't know, it sat vacant for most of the year. You simply didn't get enough rental income. One other wrinkle, I should say, when can you start deducting expenses? So let's assume you buy a place with the intentions of renting it out. You buy it January 1st. You want to rent it out ASAP, but you got to do some work to it. You got to redo the bathroom. You got to clean it up, whatever. So let's assume it takes you a month to do the fixing before you actually put it on the market. So let's assume your utility bills for the year are $1,200. I'm just making up a number. You can't deduct that first year's that first month's portion of your annual utility bill. So again, $1,200 a year for utilities, so $100 per month. If in the month of January you don't actually have it out on the market to be rented, you're in there fixing it and doing stuff, you can't deduct that $100 of utilities in that month. It's not until it's placed in service for rentals. So what does that mean? So it takes a month for you to redo the kitchen, fix it up, paint it, change light bulbs, whatever, I don't know. And finally, February 1, you say, okay, world, this place is open for rent. You post it on Craigslist, you post it in newspaper, whatever. February 1st is when that unit is actually sort of in service to be rented, even if no one's in it yet, even if it takes you 2 months to find a tenant. February 1st is nonetheless when you put it out to the world to say, hey, this is now available to be rented. January wasn't. So you can't deduct, I'm pretty certain you can't deduct, your carrying costs for January because you weren't actually actively trying to rent it at the time. So keep that in mind. A question from Mark. I'll get to that later. I don't know the answer, so I want to delay it so I can hopefully think about it in the meantime. All right, so going back to the example, I showed you have a $12,700 net gain, net income from the rental during the year. That's all taxable income to you at your ordinary income tax rates. What if you have a loss? You only rented it for 1 month out of the year. You couldn't find a tenant, whatever, and so you have a net loss. Well, if you're not a real estate professional, right, you just own this as a passive investment, generally speaking, you cannot deduct any of that loss that year against your other sources of income. You can only deduct passive investment losses against other passive investment gains to the extent you have any. If you only own one rental property and that's it for your passive investments, well, guess what? You have nothing else against which you can offset this loss. However, if you have active participation in your passive rental property, you can potentially deduct up to $25,000 of net losses per year. First, what is active participation? These are easy hurdles to meet, and most of you probably will. You own at least 10% of the property, and you made management decisions such as finding, screening, and approving tenants, deciding on rental terms, approving expenditures, etc., or you were involved in arranging for other services or people to do that. So most of you that own rental properties, you quite likely qualify as having active participation in your rental. Now, again, it's still a passive investment, most likely, but you actively participated, which means you could potentially deduct up to $25,000 of net loss against your other sources of income. But this gets phased out at high incomes. If you're anything but married filing separately, this phase out range is $100,000 to $150,000 of modified adjusted gross income. I don't know the exact definition of MAGI for this purpose. It is different from all the other MAGIs we frequently talk about. But the point is, if you made $300,000, in wages for the year, and you have a $20,000 net loss on your rental, well, you can't deduct any of that this year because you're over the $150,000 threshold, where your ability to deduct this loss is completely phased out. If you're married filing separately, these ranges are simply cut in half. It's $50,000 to $75,000 is the phase out range. After 75, you can't deduct that year. But don't worry, losses aren't just lost, if you will. What happens is you just simply carry them over indefinitely, or as long as you own the place. You carry that loss over until next year, to the extent you would otherwise have a net gain on that rental the following year. Well, you can use your carryover loss to offset some or all of that gain. Now, so you reduce your tax that year. That's how you can use up your loss. Or if you have losses for multiple years and you sell the place, or when you sell the place, if you have a net loss that you're still carrying over, you can realize that net loss upon the sale. At that point, then is when you get the tax savings, benefit of realizing all those built up losses that you weren't able to offset against other income throughout the years. So not the loss isn't all lost. Okay. What's left? Selling a rental property. Let me just hit these questions first before we move on. Whoever this was, thanks. So it's 56 cents per mile this year is the deduction. It used to be higher. I want to say it was 58.5 cents last year or the year before. I don't know why they toy with it and move it down as opposed to up. But anyway, so thank you for whoever posted this. Can you comment on how you would handle income from roommates renting rooms in your house? I didn't want to. Great question. So you basically have to prorate. I think there's definitely some sort of proration. I don't know the exact specifics, but you may still have that thing I mentioned before, where if you rent it out for 14 days or less, you simply don't have to report the income, and similarly can't benefit from the expenses. That might be the case. I'm not sure. I'm just thinking out loud. Let's assume you rent it for half the year, for example. Well, then you simply have to prorate, I think. So like if you have a 2,000 square foot house and the room you rent out is 20 square feet, that's a really small room. That can't be right. 100 square feet. That's what? That's 1/5 of your house. So if you have, $1,000 electric bill for the year, you can deduct 1/5 of it as a rental expense. The other 95% of it, you would need to, it would still be just a normal personal expense that you can't deduct. So same thing, you can prorate like mortgage interest. You pay mortgage on your house. 1/5 of it will be a deductible rental expense. Utilities, property insurance, same thing. The rent would be income. So if you rent your room out for $1,000 a month, you'd have $12,000 of gross rental income. Your rental expenses would be, as I mentioned, the prorated, 5% of your total carrying cost for your house, basically, would be the deductible expenses. I believe. Don't quote me, but I'm fairly confident that's the treatment, or something very close to that at least. Good question. Now, another thing is if you rent places for below fair market value, I doubt anyone does this in practice, but let's say like the fair market value of renting out your room should be $1,000 if you were, some random stranger. If you rent it to a relative for only $200 a month, in theory, you're making a gift to that person of $800 a month. So you would still record that $200 a month as rental income. So for 12 months, that's what, $2,400. Yeah, $2,400 of gross rental income. But the fact that you're charging this relative $800 a month less than fair market value means you're basically making that person a gift. Now, $800 is fine because 800 times 12 is only $9,600. That's still under the $15,000 annual gift exclusion. But let's say in theory that the deduction you were giving the person was $2,000 a month below fair market value, the rent they were paying. Well, you're making them a gift. And if that gift is valued at $2,000 a month, well, guess what? You're making a $24,000 gift to that person that year. The right answer is you're supposed to report that on your gift tax return. Now, in practice, I doubt anyone's doing that, but that's the right, I believe, the right treatment if you rent something out for below market. Good question. If heirs inherit rental which has been fully depreciated, then later sell the rental, do heirs have depreciation recapture? Do they also get a stepped up basis at time of inheritance? Great question. So I believe that everything is stepped up, and all of that, whatever gain there may have been and whatever depreciation there would have been to be recaptured, I think all goes away. Not certain. I'm going to say 80% confident, maybe. I could be wrong, but I do think that's the case. So let's say parents own a rental property. Married couple owns a rental property. They rent it for 30 years. It's fully depreciated, more than 27 and a half years. They pass, they leave that property to a child. I think the child gets it fully stepped up to whatever the value is at that date and doesn't have to worry about any of the depreciation or gain that there was. Again, I believe that's the answer. Mark, interesting to see that there's no difference for single versus married filing joint. Yeah, I did double check that, unless I just egregiously missed it. That was the case. The income thresholds for where you start to lose the ability to deduct net rental losses does seem to be the same for single and married filing joint. It's just married filing separate is the one that has one lower. How is carryover loss handled if you sell before you are in the black? Good question. I think it just gets tacked on. So I guess your question is, you bought the place for 300, you sell it for 250. So right off the bat, you have a $50,000 loss, and assume you were carrying a $20,000, net operating loss throughout the years. I think you'd have a $70,000 realized loss. 50 realized loss on the sale, and then another 20,000 loss of accrued losses that you weren't able to realize in prior years. I believe that's the case. I don't think you lose it simply because you're already selling at a loss. I think it just tacks on to the loss. But again, something I'm not certain on. Great questions. All right. Selling a rental property. This is where things get fun. So when you sell it, the amount of gain you have is your sales price. Pretty straightforward so far. You sell it for $500,000 minus your adjusted basis, minus certain sale expenses. So let's unpack this. What's your adjusted basis? Let's start with that. Fairly straightforward, except for the wrinkle of depreciation. So your original cost, including certain closing fees. So let's assume you bought the place for $300. You had to pay $2,000 for a lawyer. You paid $500 in recording fees. You paid $1,000 for title search, whatever. I forget the math I just did. So you can add those $3,000 or $4,000 of closing expenses to the original cost of the house. So if you bought it for $300 and you paid $3,000 in those random expenses, your cost was now $303,000. $303,000. So that's your original cost, your initial cost. Subtract from that the depreciation expenses you've taken or could have taken. Notice I bolded and underlined could have. Why? So as I mentioned before, the depreciation expenses you take throughout the years feel great because they're reducing your income and they weren't a cash outlay, those expenses. But they come back to bite you when you do sell it. You have to now pay ordinary income tax on all of the depreciation previously expensed. Well, you may be asking, well, I got it. What if I simply just don't deduct it in those years? You can't do that. The IRS will make the specific language is something along the lines of depreciation you expensed or could have expensed throughout the years. So don't not expense depreciation during the years, because you will have to pay tax when you sell the place. Pay tax on when you sell the place. So anyway, so let's assume you had $50,000 of accumulative depreciation throughout the years. So you'd subtract that from your $303,000 original cost. Now add to that any additions or improvements. So these aren't repairs. These aren't just fixing a broken screen window. This is kitchen remodels. This is adding a deck. This is completely revamping the landscaping. This is putting in a new driveway. This is adding an extension. Those are additions or improvements. The cost of those add to your basis. Here's some other sort of slightly one-off things. If you have a casualty loss, so basement floods causes $20,000 in damage, and you only get $18,000 from insurance, you have to pay the other $2,000 out of pocket. That additional $2,000 would add to your basis. If you get utility service extended to the property, so you live up in the mountains, there's no water lines or gas lines. All of a sudden, the town comes in and says, "Hey, we're going to put in municipal gas and water, but you got to pay for us running the lines there." You pay to run the lines. That gets added to your basis, because that's in effect an addition or improvement to have utilities added. Or if there's legal fees along the way to defend the title. So, someone who owned it 3 owners ago comes back and be like, "Hey, I still own this property." You're like, "No, you don't." And you got to pay a lawyer to go fight this. That would get added to the cost of that gets added to your basis. So that's your adjusted basis. Okay. And then the sales costs, the sales expenses that you can additionally deduct from your gain are things like realtor commissions. That's a biggie, 5% or so right off the top. That's a big expense. Well, that you're able to deduct from your taxable gain. Legal fees, same thing, recording fees, a good portion of the other, random line items of fees you see on realty transfer taxes, things you see in your closing statement are able to get deducted from your taxable gain. Let's now just put some numbers to this. I know I just dumped a lot on you. Here's a basic example. All right. So you have a gain I should have used sales price. I should use prices that I just mentioned before, or vice versa, but whatever. So you have a total gain. You sell the place for more than what you bought it for, and you have depreciation you took across the years. The portion of that gain that's attributable to depreciation recapture will be taxed at your ordinary income rate up to a maximum of 25%. Right? So if you're in the 12% tax bracket, the depreciation will be taxed at 12. If you're in the 22, it's taxed at 22. If you're in the 24, it's taxed at 24. If you're in the 32% bracket, you just won a little bit. The depreciation is only taxed at 25% for you because, again, it's capped at 25%. The rest of the gain is treated as a regular short-term or long-term capital gain. It's short-term if you owned it 12 months or less. It's long-term if you owned it more than 12 months. So let's put some numbers to this. Let's start with adjusted basis. You bought it for $150,000. Let's say that's inclusive of the closing costs to buy it. No, never mind. I got ahead of myself. So you had $5,000 of closing costs. You redid the kitchen for $20,000, and you had $50,000 of depreciation along the way. Excuse me. Got a tickle in my throat. It's better. All right, so 150 purchase price plus your 5,000 initial closing costs plus 20,000 kitchen remodel minus 50,000 depreciation. You have an adjusted basis of 125 grand. You go to sell the place. The contract price you agree to sell it for is $300,000 minus your adjusted basis. So this just right over here minus your 125 grand adjusted basis minus, let's assume it's $20,000 in closing costs. The lion's share of this is going to be the 5% realtor commission. That's 15 grand plus 5,000 of legal fees and other mumbo jumbo. So your total taxable gain now is going to be $155,000. This $155,000 will show up on your 1040 as gross income. It'll show up as like that other income capital gain line. But behind the scenes, there's other worksheets to split this out and figure out how it's actually taxed. Of this 155, 50,000 of it, that was the total amount of depreciation. 50,000 of this 155 is recaptured depreciation, which again, it means it's taxed at your ordinary income tax rates up to a max of 25%. The rest of this 155, so that would be 105,000, is taxed as regular capital gains. So it's either short-term or long-term, again, depending how long you've owned the joint. Capiche? So this is what it looks like to sell a property in super dumbed down, overly simplistic example. I have a few other comments before I get to that. Let me just see what other questions we have. I already did that, sorry. So speaking of this, so what happens if you have a carryover loss? So let's assume you had $20,000 of carried over losses you weren't able to deduct in prior years. You would just take it off the top here. Now, I don't know if that comes out of depreciation or your gain. I'm guessing it comes out of your gain. I really don't know. But point is, you would have 20,000 less of top line taxable gain here. Man, tonight's topic is not doing it for people. 31 sets of eyeballs watching. That is maybe the lowest yet in the year and a half of me doing these things. Not surprised, I guess. Okay. So now, hypothetically, what if this thing was at a loss? Well, how does depreciation work if you're selling at a loss? So let's assume the market tanked from when you first bought it. You bought it for 150. Let's assume now you're only selling it for 120. So right off the bat, you have a $30,000 loss before you even add in realtor expenses and other stuff. So you have a loss. And you took 50,000 depreciation. Well, the depreciation you won't have to recapture in this case. I believe this $30,000 loss is just simply it's a net loss. You would be able to deduct that against ordinary income. It's like any other. Hold that thought. If you do have a net loss, can you only use 3,000 of it per year against ordinary income, just like you can with normal investments? That I don't know. I don't know if you can realize the full 30,000 loss now because this was considered a bit. You probably, I think you can, because this is business property technically, not a normal investment like a stock or a bond. I do think if you were to have a net realized loss of 30 grand when you sell it, I do think you can offset that 30 grand against other income. Worst case, maybe you can't, in which case you'd have to treat it like selling a stock or a bond at a loss. and you can only deduct $3,000 a year against other income. I'm honestly not sure about that. I think it may be the latter, or the former. I guess it is the former. But anyway, point is, if you do have a net loss just from like the sales price itself, I don't think there's any depreciation recapture. That just sort of goes away. You only have to recapture depreciation to the extent there's a gain on the place. So here's to further confuse you. Let's assume you sell it for 170. So you have a $20,000 net gain. Disregard the rest of the noise. So $20,000 net gain, but you have $50,000 of depreciation. I believe what happens here is all $20,000 of that gain will be attributable to depreciation recapture. So that'll be taxed ordinary income, and then that's it. I think the rest of the depreciation recapture, just you don't have to realize that now at this point. It's you only realize it to the extent of the gain you have on selling the place. I think it's another one of these things I'm not sure about, but I believe that's the answer. Mark raises a good question. So if you do have a net loss on selling it, again, you sell the joint at a loss of $30,000, can you offset it against other income for the year? I don't know. Mark raises a great question. Maybe you can only offset it against other passive gains that you have. Good question. If anyone know, hold on. Hussein sold the rental property in 2010 for a loss. It wiped off all my active income for the year. Hussein, by active income, do you mean like, your wages and other normal income? You were indeed able to have this loss completely offset those without having to net it only against other passive investments and stuff like that. I think that's right. That feels right, but I don't know that for certain. So cool. Yeah. So okay. So Hussein, yes, had W-2 income, was offset by his net loss on selling his rental. Good to know. Thank you, Hussein. Okay. Yeah. If you don't rent the place during certain years, you still have to subtract depreciation for those years. It depends, I think. So if you take it out of service, so you're no longer actively trying to find tenants. You're like, let me just sit on the place, let it sit empty, whatever. No, then I don't. I don't know. So like, here's why I'm confusing myself. If you own a vacation home, for example, so you have your main house, you own a beach house, mountain house, whatever tickles your fancy. You don't deduct depreciation of a rental of a vacation property. And similarly, when you go to sell it, you don't have to do any sort of recapture. It's simply like if you buy a vacation property for $100,000 more today, more like $500,000-$600,000, and you sell it in a few years for $200,000 more, you simply have a $200,000 gain, tax, long-term capital gain period. There's no depreciation or anything like that. So that's if it's your own personal use property that you're not using for a business or a rental. What I don't know is you have a place you use as a rental for a few years. Then you decide, let me just use it as a vacation house for a few years. Then you fire it up again a couple years later as a rental. I don't think you deduct depreciation. I'm fairly confident you don't deduct depreciation in those years where you're not actively trying to rent it. Furthermore, I wouldn't think you'd have to recapture those years of depreciation when you sell it. It's just the years it's in service as a rental where you have to expense it. And if you don't expense it, you have to recapture it when you do sell it. Great question, whoever this is. Is there a benefit to establishing an LLC as the owner of rentals? I'm not a lawyer, nor do I play one on Facebook Live. Depends who you ask. And I asked this very question of a couple of different lawyers when I bought. First, it was one rental, then I bought a second. I've since sold them last year because the market was hot and felt like the right time to get out. But anyway, in theory, you should, because LLC provides protection, legal protection, that if someone slips and falls or has a raging party in your rental and someone falls out a window and dies, they, in theory, can't pierce the veil of the protection of that LLC. And some of this may depend on your state. I really don't know. But in theory, they can't come after you personally. They can only come after whatever the LLC owns. But here's the rub, and here's the advice I got from a few different lawyers when I bought my first rental, was they said, don't bother. Unless you truly own like a big sort of living, breathing business of rentals, it's probably not going to matter. If you just own one rental, and someone slips and falls and dies, I was told by multiple lawyers, and maybe they're all coincidentally wrong, but I was told by them that no, the judge will see right through it. They'll see that the LLC isn't practically its own business. It's just purely me trying to shelter myself. So that they didn't think it would hold up. The other wrinkle was that I did have a mortgage to buy the place, and like the mortgage would need to be in the name of the LLC. And when I started the LLC, it had nothing. It was $200 to open an LLC online or whatever. If I would have, it would have no assets. It's not capitalized. So the LLC can't actually get a loan because it has no income. It has no assets. So I had to get the loan personally, which further weakens the idea of the LLC providing protection. Again, this is all what I was told from lawyers. Do not take this as advice from me. Do your own research. So that was the advice I was given, and it would complicate the tax return a little bit, and annual LLC report filing to the state. So I was told don't bother. Now, if and when you do get a bunch of rentals and you get some real capital behind your LLC such that it does look and feel and act like it's its own business, then I was told it would make more sense. Now, other folks, I've read on some message boards and stuff online that people are like, absolutely wrong. Always have an LLC for every property you own, period. I don't know. I don't know what the right answer is, but I was told here in New Jersey, at least, that it wasn't worth the hassle just to have one or two rentals. Good question. Oh yeah, exactly, Mark. Maybe low eyeballs watching because most people hire a tax professional to figure this all out. A lot of moving parts. Exactly. I am a tax professional. This is one of those areas like I don't know what I'm doing. I do have clients I work with where plan on selling a place that was a rental for a long time. They've lived in it for the last 2 years, and the question was, if we sell it this year, what are taxes going to look like? And I researched it for a few days, and I was like, I just can't get comfortable with thinking I understand the answer or what the answer should be. So I actually worked with them and say, it'd be in your best interest to not use me to do your taxes this year or give you specific advice on this because I frankly can't figure it out. I can do a lot more work to try to figure it out, but why not just find someone who does this, who knows this with certainty? So that's what we did. And that might be the answer, Mark. A lot of people are like, you know what? If I don't know enough that I need to watch some dude on Facebook talk about this to try to figure it out, I should probably be hiring help to do it. And maybe that's the answer. And probably only people who have rentals or are interested in rentals are going to have any interest in watching this in the first place. Otherwise, other people probably don't care. All right, let me hit the last slide before I get to the rest of these questions. Other sale considerations. This is where I'm real fuzzy, so definitely don't take any of this as specific advice to any of y'all. If you own, because a rental is a business property, it's deemed a business property, you can do something called a 1031 exchange when you sell it. That simply means, I'm dumbing it down, but simply means you sell the place, instead of having to realize the taxable gain and depreciation recapture, you can just roll over the sale proceeds into the purchase of another similar investment / business / rental property. Now, this doesn't get rid of tax. This just merely delays it. It kicks it down the road when you eventually sell the place. Even if you exchange it to another, sell that, exchange it to another, blah, 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 you're just kicking the tax can down the road. Now, step up in basis may work. I don't know for certain, but when you eventually die, as Meryl asked before, I'm fairly comfortable in saying that even if you 1031 exchange multiple properties, all that built up gain that is otherwise taxable, I think that all gets stepped up and passed on to heirs. So that may be one way to get around it. But otherwise, if you have a rental you want out of and your concern is, oh man, if I sell it, I'm gonna have a big tax bill this year. Maybe I should do a 1031 exchange to another rental. That's the wrong answer. If you want out of being a landlord, you want out of a rental because you don't want the headache, you don't want the risk, whatever, don't do a 1031. You're just delaying tax. You're not getting rid of it. And you're putting yourself into the position of still having to be a landlord and stuff like that. So really think closely about it. Now, I'm not a 1031 expert. There's a lot more to it. Like, you can't actually take possession of the sale proceeds, for example. They need to stay in some sort of escrow type account until you roll it over to the next purchase. You have a certain amount of days to find a potential replacement property before you sell, the one you're selling. So there are specialists out there that just do 1031 exchanges. If you're interested, go find one. Make sure you do it right because there are moving parts to this. Here's a common question, which I'm not confident on the answer, but this is my findings. This is my understanding. What if you rent a property out for multiple years and then you want to sell it and you're like, hey, I know a trick. There's a thing where if you own and live in a place for 2 out of the last 5 years, you can exclude potentially up to $500,000 of gain on it for married folks, 250 for single. So I got a game. Let me move into this rental for 2 years, then sell it, and then boom, hey, I can exclude whatever gain I have up to 250 or 500K. Not so fast. The IRS is onto that. They know people have done this in the past. So at some point, I want to say it was 10, 15 years ago, they it could be longer. They put this rule in place. Long story short, you have to basically prorate the time that you rented it versus the time that you lived in it as a residence for personal use. The amount of gain you're able to ultimately exclude has to get prorated. So I don't want to make this too complicated, but let's assume you owned it, you rented it out for 3 years, you lived in it for 2, and you sell it at the end. So you had it for 5 years total. 60% of it was non-qualified use, right? Non-personal, non-residential use. So 3 years were rented, 2 years you lived in it. So that means whatever taxable gain you have on you sell it, you can only exclude 40% of it. So let's put some numbers to this. You have $100,000 taxable gain on selling this joint. You lived in it in 2 of the last 5 years. You unfortunately, you're not going to be able to exclude all 100,000. You'll have to prorate that because only 40% of the 5 years was your own personal use. So of that $100,000 gain, only 40 grand of it is able to be excluded. So that's the rub. So it'll still help reduce the tax bite some, but you can't, you typically aren't going to be able to exclude the full amount of gain because of this proration concept. Furthermore, depreciation recapture can't be excluded at all. So having a rental that you move into for a few years to try to get around this taxable gain thing, only the non-depreciation gain can be partially excluded. The depreciation recapture, you still have to eat in full. You can't trim down that at all. You can't trim that down at all. So there's no getting around that, unfortunately. Let's look at the flip side. What if instead of renting it first, then living in it, what if you lived in it, then rented it, then sold it? Well, here, this is my understanding, and I asked another tax professional group I'm in, and this appears to be accurate. They do not make you prorate your time living in it versus time renting it. Now, you only have a window of 5 years, unfortunately, because to get this gain exclusion, you have to own it and live in it 2 out of the last 5 years prior to the date of sale. So this would work if you buy it today, you live in it for 2 years, you rent it out for 3 years, then you sell it. You'll still have to recapture all the depreciation. Again, you can't get around that. But the total amount of gain, non-depreciation gain you have, that is all eligible to be excluded, subject to your $250,000 or $500,000 exclusion. That does work. I don't know exactly why it's, you can get the full exclusion in that scenario, meaning own it first, live in it first, rent in it second. Whereas if you do it the opposite, rent it first, live in it second, then you have to, prorate some of your excludable gain. The reason I was told that this was put in, from what I was told, as a result of the financial crisis, because a lot of people were so underwater in their house, they couldn't sell it without getting a big, fat, juicy loss. So they decided, let me just rent it out before I sell it. So the IRS, trying to be kind of lenient with folks, they didn't want to ding them and let them eventually, not be able to exclude some of their gains. I don't know if that's accurate. That's what I was told, at least. Or maybe just out of principle, they're cool with that. The IRS is cool with that, whereas they're not cool with this first scenario. This first scenario very clearly is people trying to game it and be like, I have a rental. Why don't I just live in it for 2 years to try to get a gain exclusion? The IRS is wise to that. So there they make you prorate things, whereas this other scenario, live in it first, then rent it, they do not make you prorate. All right. That is all I have slide-wise. Hopefully that was helpful and I didn't stumble through it too much. Let's see what other questions we have. How are repair and rehab costs incurred in order to bring rental back to decent condition treated? Tenant evicted for condition of property, rental required money to prep for sale. I think it depends. So regular repairs and expenses, regular repairs. I'm sorry, fixing a broken screen, fixing a loose, knob or whatever. Those they don't add to the basis of the house. They're just deducted that year as an expense. Improvements and additions, those add to the basis of the house. So that's why I'm saying I think it depends. Like if the tenant completely destroys the kitchen to the point that you need to gut and remodel the kitchen, then that adds to your basis. That adds to your cost because that's an addition or improvement. If the tenant just is like, on the way out, has a hissy fit and punches through the screen, and you have to repair that screen for $100, that's not an improvement. That's just a repair. And repair is a deductible expense in the year you have the expense. Whereas improvements, like the having to gut and remodel a kitchen, you don't deduct it in that year. Instead, you add it to your cost/basis of your house. That therefore then reduces the ultimate amount of gain you're going to have when you sell the place. So that's where you get the tax benefit, is smaller gain when you sell it for repairs and improvements. So anyway, that's why I think it depends. Is it an improvement or is it just simply a repair? Because that has a different tax treatment. Good question. My wife and I are trying to determine who we should hire as a financial advisor because we have 3 major issues. We own 7 rentals. We just retired early at 54 and want to do Roth conversions, and I was recently diagnosed with a terminal illness. Sorry to hear that. We're not sure what specialty, real estate, retirement, or disability, we should seek an advisor. Any advice? Just ask the questions. So, I mean, I would assume I would personally want someone who's familiar with rentals, taxation of rentals, and planning opportunities around rentals. I don't think it needs to be someone who's rentals only, but definitely anyone you interview, make sure they're aware of what goes on with rentals and how to plan around them. Roth conversions, same kind of thing. I mean, any halfway decent advisor should be able to help you with Roth conversions, but you may need to also get someone who does some good tax projections and isn't afraid to get down and dirty with, income projections and tax projections and giving you tangible Roth conversion advice. So not a great answer, but, just ask the questions and make sure the people you're talking with and interviewing are comfortable in their knowledge and abilities of planning around the things that are, important and required of you. David Myers, if not owned by an LLC, worth still having a trust for management of state issues, the last thing you want, especially if you own properties more than one state, is going to probate in each of those states. Good point. So having it all in a trust, like if you own rentals scattered throughout the country and you die, you're going to have probate in multiple states. So I guess, I don't know that owning in trust would. I'll take your word for it, but owning in a trust, would that avoid I guess it would. Trust avoid probate in the first place, right? Good point. Yes. There are some structures into which one may 1031, which take all the management off your hands. Yeah, right. So there's people who specialize in 1031s. Lived in home for 12 years, rented for 7, lived in for 10 more. Prorated or totally excluded? Vaguely remember a scenario like this. Here's another how many years is this? This is what? This is 22. This is 29 years. Does that take us back more than? Yeah. So there was some change in May of 1997 regarding depreciation. I don't know exactly what it was. I've never come across a situation where it mattered because properties were all bought after that. But the treatment of how you recapture depreciation changed. Places you bought and or depreciated pre May 6th, I think 1997, have different tax treatment than places that were bought and depreciated after. I don't remember specifics, but I'm just adding up the math here. So you own this place for 29 years. That takes us back more than 1997. So I'm going to say I have no idea. This question may be more complicated than it appears on the surface because there may be a bifurcation of treatment pre-97, post-97 to further complicate things. So I really don't know whoever posted this. Sorry. You used to be able to exclude the whole thing. That's why people still remember it. It was changed 2010, I believe. It's now yeah. Okay. So this is going back to, you can't just rent a place, live in it for 2 years and walk away with full exclusion. You used to be able to, but IRS crackdown. If my income is less than 40,000 and I sell my condo with 100,000, no capital gains. So by income, I'm assuming you mean like you have 40,000 of wages and you have $100,000 gain on the sale of your condo on top of your 40,000 of wages. You will still have cap gains. Go back to, I don't know if it was last week or 2 weeks before, the video I did, the live I did about capital gains, and it'll explain how capital gains has its own progressive taxes. Only the amount of the gain within $40,000 of taxable income is taxed at 0. Any amount of gain above that is taxed at 15, assuming it's long-term capital gain. And then there's also 20%. So no, if your total income inclusive of the gain is 140, you definitely will have some gains tax to pay. Now, you didn't say here, but if this is your primary residence, you never rented it and you're selling it and you owned it and lived in it for at least 2 out of the last 5 years, then all this gain will be excluded because you can exclude up to 250,000. But if this is a rental you're referring to, then you will have it will be taxed. What's this? Yeah. Okay. Right. So you just clarified. So profit 100,000 plus. Yes, you will have capital gains tax on that. Again, unless it's your rented okay. So yes, your rental property. Yep. There will be tax. Dave Myers, before 1997, you didn't have a exclusion. Primary home had gains rolled forward the way we do 1031s. Oh, interesting. Good to know. Thanks. Okay. All right. 12, 7, 10, rented 20. Yeah, this is back to the other one. Lived in it, rented, lived in it. I don't know the answer to this, honestly. This is definitely one of those areas where I wouldn't be comfortable trying to advise a client, and I'd have them seek outside expertise. Alrighty. Any other questions? Hopefully the 30-ish of you who watched this found this interesting and not too mind-numbing. Definitely a very focused, narrow topic. Next week, got a real good one. Chris Kirkpatrick, insurance expert, doesn't currently sell insurance, which I like, but used to. We are going to talk about using cash value life insurance as a retirement planning tool. Get this question all the time. You'll see people pitching this, selling this all over the place through Facebook groups, on YouTube. It goes by lots of marketing names: private reserve account, laser fund, bank on yourself, infinite banking, LIRP, life insurance retirement plan. There's infinite number of ways people try to pitch this and sell, but it's all just cash value life insurance. Anyway, so Chris Kirkpatrick will be on. He's a real agnostic guy, knows this stuff well. He'll be able to give the skinny what's good, what's bad, what may work, what may not. The sales pitches you see can possibly play out like they show, but there's lots of ways they can go wrong and fall far short of the glossy, rosy projections that they show you at the time of the sale. So you'll definitely want to watch that. That's going to be good. I'm personally looking forward to it myself. I look forward to all these. But anyway, that'll be next week. 7702 plan. Yeah, it's another name for it. That's just a fancy masquerading term for cash value life insurance pitched as a retirement income tool. What is this? Yeah. Okay. Looks like that's it. Thank you all. I will see you next week. Definitely come back next week for Chris Kirkpatrick talking all about cash value life insurance as a retirement planning tool. Going to be awesome. Take care. Have a good week.